All right, so everyone's talking about how challenging the upcoming couple of years are going to be from a budget perspective, and that means you need to take control of how dollars flow out of your organization. So, how do you do that? Well, it starts with the data, and specifically data on how, where, when, and with what frequency purchases are being made all across your various departments. You may or may not have a procure-to-pay platform that makes it easy to measure this type of activity, but to get you inspired, you should go check out Procurify's brand new Charter School Benchmark Report. It just came out a couple weeks ago and offers 10 procurement benchmarks from charter schools across the country, highlighting things like average PO volumes, spend per vendor, items per vendor, how long it takes to go from requisition to PO, and so on. Not only will you be intrigued to answer these same questions for your school, it might also shine a light on opportunities for cost control next year. You can go to procurify.com/resources to download a copy or check out the episode description, and we've linked to it there as well. All right, now back to the show.
So a few years ago, or maybe 5+ years ago, one of our properties came up for sale, and I think it was for around $5 million. We were looking at buying it, and for some reason, we were unable to execute that purchase. So we continued to rent for 5 more years, and then came back to buy the facility here in the last couple of years, and we paid just under $10 million. And we've been paying rent, for the last 5 years on that same building.
Welcome to Charter School Insider, lessons from the nation's top charter school operators, the only podcast dedicated to the behind-the-scenes business of running a successful charter school. Join us as we sit down with charter school leaders who share how they are overcoming the biggest operational hurdles facing their schools today.
All right, everyone. Today's guest is Mark Kalpakgian. Mark is the Chief Operating Officer for the Classical Academies, a group of 7 independent study charter schools serving a little over 5,000 students in the greater San Diego region. Mark is also Chairman Emeritus and Board Member of the San Diego North Economic Development Corporation. Mark holds a Master of Humanities degree from the University of Dallas, and as a C-suite executive and former management consultant, University Dean and International Education Director in Austria, Mark brings the worlds of business, education, and development together in a unique way to affect and influence positive social change. Mark has traveled to over 27 countries and is also the father of 7 children. He is co-author of Stars, Stripes, and Edelweiss, An American Family Braves Austrian Living. On today's episode, Mark and I dig into his experiences leading over $100 million in bond financing to help the Classical Academies grow and scale over the years. Hope you enjoy the episode. Mark, let's get right into it. Should a charter school buy or rent their facilities?
I am a big fan of buying facilities if you plan to be in that site for at least 6 or 7 years. If it's under 5 years, renting is probably a decent way to go so you can evaluate if that property is right for you in the long term. But if you've really found a great property and you see yourself in there for 10+ years, really moving to a place of how can I purchase this site is where I recommend folks aim their energy and their vision. There are a lot of benefits to buying over renting.
Got it. So 7+ years. Talk us through, you mentioned there's a lot of benefits to buying. Specifically, what comes to mind? Like, talk us through some of those key benefits to actually owning the facility.
If you buy either with a conventional loan or through bond financing, you have the ability to secure an interest rate similar to purchasing a home over a period of 20, 30, even 40 years. So currently you've seen what's happened to interest rates in the past couple years. They've escalated from the 3s to the 7s.
Right, sure.
And that volatility, if you didn't get in when the timing was right, school operators and homeowners are really disadvantaged in the current market. So when you're in a good market and you're able to secure a good rate or you're able to refinance, that really helps your sustainability and your financial modeling over the long term. It also hedges against rising property costs. So a few years ago, or maybe 5+ years ago, one of our properties came up for sale, and I think it was for around $5 million. We were looking at buying it, and for some reason, we were unable to execute that purchase. So we continued to rent for 5 more years, and then came back to buy the facility here in the last couple of years, and we paid just under $10 million. And we've been paying rent, for the last 5 years on that same building. So that, hedging against those rising costs is another major benefit. Just from a general finance and wealth building perspective, building equity, making payments where then you start to own that facility versus making payments to a separate owner. You're basically paying off his mortgage versus your own. And then once you start to build equity, you can use that equity to take loans on other projects, improve your bond rating, your credit rating to other investors, and just generally improve your balance sheet from a financial perspective. It also gives you an opportunity, if you're renting, there's all these upgrades that still need to happen. So what normally happens is you end up upgrading the owner's facilities, investing in his property, which makes the price go up. And then again, when you want to buy it, it's worth more. So you're basically paying twice when you end up buying it. Or if you don't end up buying it, you've just upgraded his facilities and walked away.
Sure. So you may be disincentivizing yourself to be able to purchase it if you pump too much into the improvements while you're renting.
Some of us are blessed with great landlords, and then others are not. So when you buy, you kind of remove that element where, there's some human dysfunction, I call it, or playing bumper cars with your landlord. Some of us who have lived for a short time in an HOA kind of know it's so much more difficult to operate when others are calling the shots versus under your own management and leadership. So everything from finances to hedging against rising costs and inflation, facilities upgrades, and even the human element are reasons that a school operator should look at buying versus renting.
So it certainly sounds like there's a lot of pros. So if I'm a charter school and I'm thinking about considering a property purchase, for all the reasons you mentioned, maybe I've talked to some peers, read through, how this is going to benefit our growth plans and our plans to scale. Where do you even begin? You all have grown tremendously over the years. Like if you could go back in time, you mentioned a really specific example of that building that was worth $5 million and then the price doubled. And so if you could go back and give yourself or your network advice on considering a property purchase, where would you start or where would you recommend someone start?
It's important to do appropriate due diligence anytime you're doing a major purpose or investment, whether, it's for your own stock portfolio, whether you're hoping to buy a business or in this case, buy a property. So there are several key elements to that due diligence process. I can quickly describe some of those pieces. Number one, you want to have your real estate firm conduct a detailed appraisal of the property. Schools are kind of notoriously difficult to appraise because there's not a lot of comps out there. The comps can differ very, there's a wide range based on if the property's upgraded or not, if it's what location it's at.
Can it vary even based on who the appraiser is that you happen to get?
Oh yeah. Yeah, absolutely. So it is very good to at least, find somebody that's going to represent your interests and be able to really spend the time running the numbers and evaluating all the different components that go into an appraisal. So you can start, that's your baseline for negotiations in terms of making sure you're not overpaying on a property. So I would start with the appraisal. Second, there's something called a phase one environmental study. And that's basically a high-level overview of any environmental concerns that could be associated with the property. This has influenced several of our properties. One was close to a gas station and they discovered some vapor leakage that was coming up into the building. And it was very eye-opening having that study, and it caused additional pieces that are still ongoing today. In another property, it caused us it was one of the reasons why we fell out of escrow was through that phase one. We saw there were to be a lot of complications due to the history of that property, and getting approval from the city to put a school site on that property was going to be very difficult. Having that phase one and knowing what you're getting into is very important as well. If they do find things, then they go to a phase two or even a phase three, but that initial phase one is a great starting element as well. And then it's always important to do what they call an ALTA survey. It's a civil engineering survey of the property boundaries. So you're very clear in terms of what it is you're actually purchasing. I think we've all heard stories of, in the home environment where neighbors have a dispute over where the fence line should be here. This is
Sure,
actually
right.
my property. You really need to get, hone in to make sure that, what they're telling you is actually verified by the survey. The other thing to do is to do a property inspection. And again, if you've been renting for 5 years or so, this is probably less important because you already know the ups and downs in a building. But when I've done property inspections on possible sites, we've found, there could be things such as asbestos that's going to complicate the build process. You need to know about that before you're going to get into it. And
Right.
you get these plans of remodeling. There could be, I've even found some structural issues with a building. And then that could be millions of dollars to fix. And so you really you really do not want to miss that inspection piece of the purchase or due diligence process. When you find things or when things come up, then it gives you additional negotiating power with the seller to say, look, we found there are these roof issues, there's this structural piece, there's what can we do on the price? And yeah, in one of my recent negotiations, we dropped the price by $200,000 based on that property inspection and things that they found. And so all of those pieces, I think, are the groundwork for or a short list of items to do, either in tandem with making an offer or as part of the escrow process or as part of looking into making that purchase.
Got it. So you laid out a lot of the benefits of owning your own building, and in getting started, it sounds like really evaluating the quality of the building, the property, essentially what you're getting into is critical. So I would imagine, and maybe you all have had this experience too, there's a lot of schools that get into the due diligence phase and go from one property to the next property, and it feels like I can't find what I'm looking for the size of our school or what we need. At what point do you start to have the build versus buy conversation? Have you all had that internally? Is that a conversation that, as a leadership team with your board, have you had that conversation prior to even going down the buy path? What are some of the pros and cons from your perspective on build versus buy? Are you actually saving yourself, due diligence time, energy, and effort, or are you just kind of signing up for a whole additional list of challenges?
A little bit of both. That's a complicated question. What I've found to be at least one of the high level, most important criterion in deciding a build buy model is in the location of the site, whether it's land or a building. You really want to understand the zoning and its implications on an educational school zone. For example, if you're looking at buying a commercial business building that's zoned industrial or business, and you want to convert that to a school, and you're going to do some remodeling, schools have much stricter seismic components to it than businesses or industrial. And so if you're going to buy the building and turn it into a school, often you may have to put millions of dollars into upgrading the seismic components just of the interior building so that it meets code. So even, just understanding that zoning piece, and then is there an existing building or not, can really sway you one way or another.
So, and that, I would imagine that also, that could swing your budget or perceived cost one way or the other pretty drastically.
One other really important point is that zoning piece also is really important, because if a city or a county will not change the zoning to a school site allowance, you are not even allowed to have a school on that site. So it's not just even finding the property. You have to really understand if the city or the county will allow a school site there.
So on the financing front, let's say our leadership team is having this conversation. We decide we want to try and buy our building in one of these different scenarios that we've talked about. The Classical Academies, your experience, you all have done about $100 million, I think you mentioned, or close to $100 million in bond financing. Let's start with the basics. How do I even know if bonds are an option for my school?
The easiest way to evaluate that is to speak with an underwriter, a bond underwriting company, and they will look at your financial documents and be able to tell you, we think bond financing is an option for you, and we think it could be up to 5 million or 10 million or 20 million, whatever it may be. So they'll run the numbers into their own formula and kind of tell you, yes, this is an option. No, it's not an option. If you're a smaller school with a lot of debt, probably bond financing is not going to be the best option for you, because investors are going to be very leery about your long-term viability. But if you've been operating for, 10 years or over 7 years, you've got good, solid academics, good relationships with your authorizers, and a strong balance sheet, the possibility for a bond financing is much better. Investors will look favorably upon their rate of return and their success rate, and it's much more likely that you'll be able to get the numbers will pen for the school and also for the investor.
And if you wanted to get this process started, in your own experience, have you all gone to multiple firms that do this and essentially have multiple attempts at the underwriting to sort of compare the feasibility? Or do you all have a long established relationship with an investment bank? Or how have you all approached finding the right partner, I guess, on the front end of getting started?
There's two different ways to do it. You can either do what you referred to as kind of the school reaching out to several firms and seeing, all right, what kind of rates would they offer? Would they be willing to, they would run the numbers and give you a go, no go. The other option is to work with what they call a financial advisor, who basically accompanies the school through this process. And that is one of the roles of the financial advisors, to kind of seek different underwriting companies and get proposals and be that middleman.
They're kind of that broker, sort of trying to navigate the lay of the land, get you all the best possible option.
Right.
Got it. And so if a school does qualify for bond financing, maybe if you could walk us through what to expect if you decide to go that route. Like, what's that process like? Is it a quick process? Is it a long process? Is it, how much human capital needs to be dedicated to the process of completing a new bond? Like, talk us through kind of what to expect if that is an option.
It's typically, in my experience, about a 4-month process from start to finish. They will require those three due diligence pieces that I talked about in the beginning: the appraisal, the phase 1 environmental, and the ALTA survey. So those pieces can take some time. It's good to, if you're going to go to bond financing, start those 3 elements as soon as possible. But yeah, it is every week you should be carving out a day or two of time for, responding to, all the different attorneys in the process. They need information on everything from governance to leadership to finances, test scores. They literally go through every corner of the organization, and somebody's got to be that point person. It is typically about a $300,000 to $500,000 fee process to get through that. All the different attorneys' fees and S&P credit rating fees and everything that's involved with start to finish. So it's not a small chunk of change, but if you're doing a 30 to 40 year process or loan, it's not that big of a deal. There are deadlines where you're not going to miss. You can't miss them. So you just got to be very focused, carve out a lot of time for this process.
How many people on the network side for you all are involved in this? So obviously it sounds like you have been a point person for the Classical Academies. How many people, since they are doing that kind of soup to nuts evaluation of the organization to try and understand, is this school going to be thriving and performing over the next 20, 30, 40 years? Is the process, is the bond financing process involve everyone from the entire leadership team to the board, or is typically one person can kind of be the point person and track down all the information? Like, what does it take in terms of how many different people have to allocate time to this on the school side?
Today's episode is sponsored by BuyQ. BuyQ is the only group purchasing organization dedicated to serving the charter school community. Over 4,000 schools participate in BuyQ's purchasing program, which is free for schools and offers competitively sourced contracts from industry-leading suppliers like Staples and CDW Education. If you'd like to learn more about BuyQ, schedule a free purchasing strategy session with our team today by heading over to www.buyq.org/signup. That's BUYQ.org/signup. All right, now back to the show.
I would say there needs to be that point person, but then also the chief financial officer or director of finance needs to be very closely involved because it's a financial transaction that's happening. And so finance is a part of every step of this process, from the presentation to investors to the 5-year financial forecast, which is required, to audits and everything in between. So your chief financial officer needs to dedicate in that 4 months a significant chunk of time as well. And then the point person can then work with academics to get academic scores, and the CEO to work with the governance pieces and signing all the bonds, all the paperwork. But really those two people have to be committed for that 4-month process, and then other people as needed.
If you make it through the process, if you survive the 4 months, at face value, it seems like if you could lock in a favorable or an attractive interest rate for 40 years, well, it doesn't seem like there's a lot of downsides. Are there downsides compared to sort of traditional bank financing, either downsides that you all have experienced or downsides or risks that are there that may or may not materialize?
There are some downsides. Let me focus on one other positive first before we go there.
Sure. Yeah, go for it.
The number one reason I think schools do bond financing, besides the securing the 30 or 40-year fixed rate interest payment, which they could also do through a bank or other lending institution, is that when you do bond financing, you can finance 100% of the project or even the construction of that project. So in a traditional bank scenario, they require a certain percentage down, say it's 40% down. And they have a certain loan to value ratio that they only underwrite. They won't go beyond that.
You have the opportunity to get a no money down loan for potentially a multi-million dollar project or building. And you don't have to plan maybe for a couple of years to build up the reserves to put down that big 20% payment. And so that's a huge, huge advantage because you could start the bond process kind of whenever you want, not needing to build up that down payment. All right. So talk to me about the reverse side of the coin. Like what's the ugly story with bonds?
Well, I don't know if there's any ugly story, but recently there was some legislation that was passed where you can't refinance for, I think it was at least 7 years.
Okay.
So like in our current market, if you sell bonds and they're 7% and 2 years from now, they fall back to 3%.
You're stuck for those 5 years. Yeah.
If you get in at a great rate, then that's usually not a big deal, but that refinance piece can be problematic in certain markets. The other piece is that I found we've got a lot of properties that have been purchased through bond financing, and those properties are what they call bond investors are in first position. So you can't leverage those assets to do other loans.
Okay. So you essentially can't leverage that property asset because in the capital stack, the first, priority goes to the bond investor.
Right.
Okay.
So even though you've got all these assets, you'd think you could, from in the personal side, you're like, well, I could, leverage that to do this. No, you can't do any of that until they're completely paid off.
Interesting. Well, is there a percentage at which that changes, or it's 100% paid off before you can leverage that asset?
From what I understand, it's till they're fully paid off.
Okay. Got it. Yeah. So definitely important to think about if you've got a bunch of potential projects on the horizon. And any other potential downsides or risks?
There are a few. In California, they passed a law a few years ago that if you use this municipal bond financing for construction, right, that those construction costs have to be done at prevailing wage rates, which are typically 15 to 35% higher cost than regular construction.
Interesting. And who sets the prevailing wage rate? Where does that come from?
Yeah, that comes from, I think, these state and federal requirements that
Okay.
basically say moving this tree from here, it's a minimum of $100 an hour versus on
Got
the
it.
open market, it's $20 an hour.
Right. There's the competition is removed essentially. Okay.
It really, that can be a downside, especially when you're looking at multi-million dollars. We're in the middle of a construction project I think the prevailing wage costs are about $3.5 million more
Wow.
than what they would have been.
That's pretty significant.
Very significant. And then I think the last kind of piece is, there's a lot of reporting, quarterly and yearly reporting that has to be done to investors, credit ratings. And so it just takes, there's yearly fees with that. There's reporting that goes along with that. And so it's just a little bit of a commitment of time and resources.
It feels a bit like a specialized skill in the sense that it's almost a foreign language if you came up through a purely educational background and end up sitting in a seat similar to yours where you're the chief operating officer, or maybe you've spent a lot of time on the academic side and then you transition. And that, I would imagine, can be a bit daunting when you start meeting with bankers and they start throwing out all this jargon, and then you're meeting with attorneys, and it certainly feels like a foreign language to me. How did you, or do you have any recommendations from your own experience, or recommendations you would give for evaluating the right partners to go through this process? Partners meaning whether it's that financial advisor who acts as your broker, whether it's the firm itself, bankers, attorneys. Are there things to maybe look out for, or things that you've learned in working with these firms or these advisors that you would recommend another school or network maybe think about as they're evaluating which partners are going to guide them through this process?
Right. I do recommend, if you're new to this world, negotiating rates with a financial advisor to get you through the first one. So that financial advisor will teach you a lot, or guide you, to make sure you're looking in all the right places and learning the terms and prepared for the different meetings. And, they're looking over your financial numbers. And so they're a really good guide and a really good partner. Now there's a cost to that, but I do recommend that for a lot of new schools that are just beginning. And there's a lot of savings that can come from the financial advisor. They're able to, negotiate the underwriter's percentage fee. They can actually RFP that out to different underwriters and make sure you're getting the best rate. They can, they negotiate all the different attorney fees and different things. I look for a financial advisor that'd be willing to negotiate and do research on your behalf, not just act as a spokesperson, but as a negotiator. There's also something called the bond reserve fund. When you do bond financing, they require you to have a reserve fund of a certain amount of money that acts as a hedge against a downturn in your schools, whether monetarily or elsewise. They have this little cushion of money for investors, and you're allowed to actually invest that bond reserve fund and make interest off of that. So the financial advisor can also help you invest that fund and get money back annually on that little pot of money.
Okay. And is that bond reserve fund, is that typically a percentage of the total bond? That's how they come to that number?
Correct.
Okay. And so I guess the personal, I'll use a personal analogy. So it's kind of like a health savings account where that's for a certain purpose, but you're actually allowed to invest it, and then it can grow. The HSA example would be you can only use it for health expenses, but similar idea where it's kind of a pot of money for a specific reason, but it doesn't just have to sit there earning 0.001% or whatever in your Wells Fargo bank account, not to pick on them, but that can actually be invested and produce cash for the school. And is the earnings from the investment sort of unrestricted funds, or does it go back into the bond reserve fund and kind of is there as collateral, or could you take that cash and use it for other operating purposes?
You can do either of those options.
Very cool. Okay.
Yeah. So yeah, there are, your original question, having that financial advisor is a great way to hedge yourself against not understanding the process or being taken advantage of if you're just starting out.
Well, as we come to a wrap here, are there any, I mean, obviously we were just talking about the financial advisor being a critical partner to lock arms with through this process. Are there any resources that you would recommend or things that you found to be particularly helpful on your own journey navigating a variety of these bonds, doing, multi-million-dollar projects? Is there anywhere that you would point other leaders to, whether it's books or online resources or otherwise, if someone is kind of early stage, not ready to actually engage an advisor or a firm, but just wants to explore this more as a potential for their school, maybe a year or two out from thinking about a financing project?
Typically, the normal school conferences, there's always a sector on financing and facilities. So those are great places to start in terms of a high-level overview of some of these processes. I did not, read any books on this topic, but really I'd say learned a ton from using a financial advisor in the beginning and then having side conversations with that person. Help me understand arbitrage, or help me understand how we negotiate these rates at the final day, and help me understand how we prepare for a S&P credit rating meeting. Help me understand, because these people have gone through this process, sometimes hundreds of times. And so they're really, really great resources. They understand finance, they understand law, they understand the different bureaucracies. And so just being able to have one-on-one conversations with these folks is really an education all in itself.
All right. Well, last question for you. Tell us about this construction project you have going on now. You mentioned a couple times that you're working on a project currently. Can you give us maybe some details, what you're excited about, what's going on at the Classical Academies?
Yeah, all the things we've talked about in this short conversation. We originally had one property, but with the environmental concerns, we were going to build from the ground up. Rising costs pushed us to buy another property that was already standing. We had to change the zoning, which we talked about, and then we had to, invest in the seismic upgrades of that property, moving it to educational zone. But once we've got through all of those pieces, we are now in the midst of about a $32 million campus renovation project for our Coastal Academy High School. Should house between 800 and 1,000 students, and putting in a specialized culinary kitchen, a dance room,
Wow,
a weight room, some new science labs, and a beautiful outdoor quad area. So everyone's really, really excited. We've got the build permits, construction is in progress, and we are, seeing weekly and monthly, the buildings are coming together. So that's what's keeping us excited over here. And the bond process and all of the different studies, it's been grueling and grinding but at the end of the day, we can see it coming together, and that's what makes it all worth it.
Well, that's a good encouragement, a great note to end on, that the process involves all of the different aspects that we talked about, but keeping the end game in mind. And I would imagine your high schoolers are pretty excited about this project too, for the ones of them that will be there when the project's complete. So Mark, thanks so much for coming on today and sharing more about your experience. For those listening, we'll link to some different resources that we talked about today, and other resources related to bond financing if you want to explore that more. And if you want to learn more about the Classical Academies, Mark, where should people go to learn about TCA?
classicalacademy.com. And then our social media channels. We do also have an award-winning podcast as well called Partnering with Parents. And we're on the cusp of starting some free parent training courses as well.
Awesome. All right. Well, we'll link to that as well in the show notes. All right, everyone. That's it. Thanks, Mark.
I know. Thank you.
Thanks for listening to Charter School Insider. This show is brought to you by BuyQ, the group purchasing organization specifically for charter schools. Want to learn how to maximize your school's purchasing power? Join together with thousands of other charter schools by visiting buyq.org/sign up. BuyQ's purchasing program is free and has no obligations or commitments required. If you enjoyed today's episode, do us a favor and subscribe on your podcast listening platform of choice. If you have a question or feedback for us, we'd love to hear from you. Send us an email at podcast@buyq.org. Thanks, and we hope you'll tune in for the next one.